Just a few words here about stock-based compensation, the details of which are usually in the notes in the financial statements. Now, stock-based compensation is important largely for two reasons. One is that a high degree of compensation to your employees and your managers usually helps align an individual's interests with the performance of the company. And that's usually a good thing when not taken to too great an extreme. The second reason to make sure that it's being calculated is that it affects the difference between basic EPS and fully diluted EPS. You can imagine if a company has a lot of stock options outstanding, the exercise of which would lead to issuance of a lot of new shares, it'd be very easy to overstate the earnings per share of the company in trying to value it. Now, there are three types of stock-based compensation, really. One is options, which is the right to purchase stock at a fixed price at some point in the future, regardless of the market price of the stock at that time. The second is stock awards to management, usually come with some form of restrictions over a vesting period before they become irrevocable and permanently owned by the employee. And the third is an employee stock purchase plan, or ESPP. This is a plan whereby employees have the right to purchase stock over time and effectively reinvest back into their own company. All three of these factors, as I said, can lead to dilution because the shares that would need to be issued to exercise the options, future stock awards that could come as they come vesting, and of course stock that the employee might purchase need to be calculated carefully in terms of estimating the fully diluted EPS. For some companies, it's not that significant. And in fact, for a company like Nike, the proportion is really just about 2% difference between basic and fully diluted EPS. But for some high growth technology companies, the difference can be quite a bit more significant.